You might realize from some of our earlier episodes, I have been interviewing entrepreneurs specifically about how they handle their finances. Instead of interviewing them individually, it would be better to get someone who has experience of 10,000 startups and 10,000 entrepreneurs.
My dad would say, this is 500 rupees. Now you can choose to keep it with you and give it back to me after a week. And I will pay you 10 rupees interest of this. I would go and eat out every day, just alone, but just eat out. Even in office, like people would get the lunch from Darshini's and all that. But I was like, no, I'm going to a 5-star to eat. Everything that today I would advise youngsters not to do. So it's better to have a shop, more manageable portfolio. Instead of investing in like 15 or 20 funds, pick the ones that has worked for you and shorten it to 4, 5. I do a lot of angel investments in startups. Mm-hmm. And that's where, all the risk comes in. That's next to gambling in a way, right?
I disagree. It's not gambling. It is losing money.
If your child is worthy, you don't need to leave anything for them. And if they are unworthy, however much you leave, it's not enough.
Poot kapoot to kyun dhan sanchay aur poot sapoot to kyun dhan sanchay. Hello, and welcome to another episode of Desi Fire Podcast. I'm your host, Ravi Handa, and on this channel, we talk about personal finance, financial independence, and early retirement. Today, I have Madhurima Agarwal with us. She leads the Microsoft for Startups part and also is a graduate of IIM Ahmedabad. She has had a long, illustrious career at NetApp and a very long time at Microsoft as well. And in this journey, she has encountered a large number of startups and startup entrepreneurs. As you might realize from some of our earlier episodes, I have been interviewing entrepreneurs specifically about how they handle their finances. And I thought that instead of interviewing them individually, it would be better to get someone who has experience of 10,000 startups and 10,000 entrepreneurs to tell us how the stuff goes. So welcome, Madhurima. Welcome to the show.
Thank you, Ravi. Pleasure to be here.
So, Madhurima, I'll first like to probably start with your own personal relationship with money, so to say. So what's your earliest memory of maybe handling money where you took a financial decision on your own?
I think my relationship with money is, I don't think that money is very important in life as such, although it's required, something that you need to have. And my philosophy is that God gives everybody enough that they need. So that's always there. In terms of the first, I think I grew up in a business family, and money was everywhere. If you see, at the shop, people were giving cash, counting every day. People would see how it's saved, stored, weekly, monthly. The accounts would be balanced. People would talk about all the time. People would talk about how we should save money, make money, invest money and all. So that way, money was not very new for me. And thus, my first experience with the financial decision, I think probably from the time I can recall, the earliest time it was there. So I remember my dad would say, this is 500 rupees. Now you can choose to keep it with you and give it back to me after a week. And I will pay you 10 rupees interest of this. But if you choose to spend it, then you don't get that. And, right from that time, that was inculcated that there's money, but if you save money, you'll get more of it versus you can choose to spend it. So those decisions started shaping. I remember the first time I earned money on my own was when I was in 9th grade. And I had my summer holidays, and there was an uncle in the mohalla. He had just got a computer and internet had just started to come. He's like, I'm getting emails. I don't have time to check. So can you help me? And I was like, yeah, how much will you pay me for it? So every day I would just go 10 minutes, check his email, tell him this is what has come. And I got paid for it. And I still remember that's my first.
This is when late 90s is what we are talking about here for the emails we check. See, because I very distinctly remember some of the things that I have done to make money. So in the early 2000s, when Gmail got launched, it used to be a really big deal. And it was probably one of the few mass level products which you couldn't just use. You had to get an invite at that point of time, which has now become a commonplace thing. But Gmail was probably the first big product to have that. And I think Gmail had launched with something like a 1 GB or a huge amount of storage capacity at that point of time. So I was a little early into the game. So I got a lot of invites, and I remember sending invites to people that, okay, you want a Gmail invite? I have one, I'll sell it to you. So that's not. So let's move on from the first money you made to probably the first time you got paid a salary, so to say. So do you remember how you spent that? And let's say in the first year or so, how much were you investing? Were you putting it towards, maybe you had some sort of a loan at that point of time? How was the first year of earning like?
Yeah, many things I did I'm not proud of today. So actually before I earned my first salary, I did run my own company, while in college. So I was earning money then, but then it was, everything was being invested back into business. But after IIM, when I got my first like corporate paycheck, and pretty decent one by then standards, then I just spent it all, Ravi. And it kind of went in all the things that I thought were cool things to buy, cool things to gift. Just spend it. Like, who wants to save money? There's so much I'll be getting, right? That was the thought then. So that's why I said not very proud of what we did then. But I think that was the time when I really splurged almost everything. Yeah, like the customary, like some part of it I'll share with my parents. But everything else was just being spent on what I wanted to do.
Where was this job with City? Was this in India?
Yeah, this was in India. So I took up a job in Hyderabad because I was very clear I don't want to go abroad. This was Hyderabad. Hyderabad's not a very high cost city then, fairly decent. But I would go and eat out every day, just alone, but just eat out. Even in office, like people would get the lunch from Darshini's and all that. But I was like, no, I'm going to a 5-star to eat. So that was the kind of lifestyle I had for the first year. And then, by the end of it, I was like, okay, I've done everything that I had been waiting to do, splurged. I was in a big city living in a big city alone for the first time after having born and brought up in a place, Ranchi. So then, you had access to so much stuff. There was so much shopping every day. Just go out, buy, eat out, watch movies, spend on gym memberships. Everything that today I would advise youngsters not to do.
I would strongly disagree with that advice. See, because, at the end of the day, the purpose of money is to be spent on things which improve your quality of life in some way or the other. Now, potentially the 500 rupees that you spend that point of time, if you have actually invested that would have been a much bigger amount today. There is no doubt about it. However, I would say that money was maybe not invested in stocks, but it was invested in building an asset of memories, so to say. So there is this fairly good book that I like called Die with Zero, which essentially talks about this idea that when we, what a lot of people end up doing is they keep on postponing these sort of spends, so that, okay, we'll have a larger amount of money, and when we pass away, we will probably pass it on as an inheritance or a charity to some cause that we believe in. When Die with Zero essentially argues is that whatever money that you are essentially saving for passing it on does not really work. So either you spend it on yourself and then you end up dying, if your last check bounces, so to say, and you are done with it. And even if you want to give away some portion of it as an inheritance or as a charity, don't wait till you're dead to do it. You give it away, when perhaps you understand that, okay, I don't really need this money. I'm already 65, 70. I would rather pass this money on to my kids today or to whatever charity today. And at the end of the day, when you actually die, you have zero in your bank account. Because even for asset transfer, that idea works very well. And a lot of other philosophy, I would strongly recommend you, as well as all my listeners, to try out this book called Die with Zero. That works brilliantly on that. So, so after that, essentially, everyone started saving at some point of time after that. So, do you remember when did you buy, let's say, your first stock or your first mutual fund or your first real estate?
Yeah. So after a year, I got married. And I think after that momentous occasion in life, suddenly perspective changes, right? Now it's like, now I have a family and I have to think about the future. And having lived in the first day everything that I wanted to do, there was more balance, there was more calmness, I think, in my mind. And that's when, as a couple, we started to think about how to invest in them. And I was working in the finance sector. I was actually an investment analyst for a hedge fund. So, knew the power of all these things that we talk about, the power of compounding, how investments make sense long term. And also we decided, and that's when we, in the first year, really, for 6 months, I would say probably just passed by. But after that, it was a very disciplined and structured approach that we started to take. So invest in stocks, the first thing. And being a stock analyst myself, right, I made a conscious decision. I will invest in mutual funds, equity mutual funds, and not individual stocks. And many people find that surprising. Like, you're an analyst. Why don't you invest in individual stocks? Because you don't have to pay the mutual fund companies the charges and all. Being a fund analyst myself, or being an equity analyst myself, I knew how much work, effort, research goes into suggesting a stock that these fund houses do, right? Whether it's, and then after that hedge fund, I worked at Goldman, and same principle, right? The amount of work I would do in writing a stock note, whether it's a buy, hold, or a sell, that's not something I could ever do as an individual. Because I didn't have even access to those resources, right? Like, as an analyst, you have access to Bloomberg, Reuters, you get on top of the news, like, live news, what's happening when. You see how the prices are moving. So for me, it was always that I would invest in equity, but as through mutual funds, because I have very high trust in the amount of effort and research that goes in deciding where the fund is investing its money. So very quickly, we started doing all those investments. First real estate, I think we bought 4 years into our marriage. And we bought that in Hyderabad because that's where we were working. And very soon, jobs changed and all. We moved out of Hyderabad, moved to Bangalore, then to London and all. But we made that investment because it was very important to have one house in our name, whether we live there or not. And Hyderabad being a city, I'm a very avid reader, so I read a lot, Ravi. And about real estate, one advice I read everywhere was that it's location, location, look. That's the 3 things you need to see when you're buying real estate. And got the house in Hyderabad, growing IT hub, then, got it in a place which was right next to Google, in one of the buildings there. Today, that area is transformed. We did sell that off, but that's a different story. So, yeah, very quickly, once we started earning, there was, a couple's dual income that's coming in. One of the income was enough to take care of the everyday expenses, and the other one just went into investing across asset classes, which is equity and real estate. Didn't do debt then, really. I mean, there's a long time horizon for us, so would take that.
Anyways, I believe that since both of your husband is also in a salaried job.
He's also in salary job.
Yeah, so I do believe that both of you will have a lot of these compulsory deductions which would be happening in PF
Yeah.
and APF and perhaps also in NPS of some sorts, which a portion of that will be. So your debt portfolio anyways gets built up
Take it.
initially. And so I do agree with that argument. I'll just like to dive a little bit deeper into the mutual fund aspect of it. So, when you started investing in mutual funds versus, let's say, today, what you know about the world, about the markets and stuff, is it still that bulk of your portfolio or bulk of your long-term investments are still going into mutual funds? And part B is it the same mutual funds which is going into, or you have taken a call on that, okay, at that point of time, it was this particular mutual funds, and now I'm investing in maybe a different type of mutual funds today versus when you started?
It's still mutual funds. That has not changed. That philosophy still holds. All the more, right? Over the years, having seen so dabbled in stocks also on the side after hearing from everybody that stocks is way more interesting, but very quickly came to the realization for me, stocks is not really. I don't feel that I'm doing enough justice by investing in stocks. So it's still mutual funds. In terms of the types of mutual funds, that's changed with age, Ravi. Right? Earlier, it was all 100% equity because there's a long run where you don't need the money immediately. There's no big expenses coming up. But over the years, there are milestones which are, short term. We would need money for our children's education very quickly. As soon as next year, then for the next kid, it's sooner. So money has shifted. It's not just equity anymore. Now there's a more balanced approach and again, basic principles of asset allocation. Whatever money you need in the next 3 years, you kind of keep it more on the debt, mutual funds, or, emergency money stays in the liquid funds kind of thing, and the long-term ones, which is greater than 3 to 7 years, that kind of goes in your equity. So that percentage allocation has changed. One big change that has happened is earlier, we were investing in a lot of different fund houses, right? That also I learned over the years, it's better to have a more manageable portfolio. Instead of investing in like 15 or 20 funds, pick the ones that has worked for you and like shorten it to 4, 5 or 7 kind of thing. So those are some changes that has happened over the years.
Sure. I want to, I'm going to keep pressing you on the mutual fund bit. So now you are essentially taking an asset allocation approach, which is a lot more prudent to do considering that you have some expenses which are coming up and you need to take care of those. But even when we talk about equity funds, I'm fairly sure when you started versus today, there is a much larger choice of mutual funds that exists. There is a much larger choice of types of funds that exist as well. So are you looking at it more of a, let's say, a passive versus an active mutual fund where you're potentially going in some sort of an index mutual fund? Is that the approach you are taking now? Or is it still, I used to have HDFC Flexi Cap Fund 15 years ago as well, and I still have that HDFC Flexi Cap Fund, which is continuing. And let's say if you are deciding today, because essentially you're making a decision today also, you are saving some money, your husband is saving some money. Where does that money go in today? How do you actually decide that, okay, this particular month, I have some SIPs which are running, but B, there is some surplus which will be left over with that SIPs. How do you take a call on both of these and actually selecting the funds in which you are putting money in?
So I think I'm a pretty conservative investor, not a very aggressive one or risk-taking one. So mutual funds earlier also were more the large cap ones, invest where there's less risk, and that still holds today. It's still that. In between, I think there was some inclination towards the mid-cap funds and the small-cap funds. But looking at the market conditions, right, given that there's so much volatility that's happening and me not being like a big risk taker, it still is more concentrated on the large funds. In terms of active and passive, I think it's more active ones, like, just invest in the ones which are top of the charts. The returns have been consistent over the longer term. Look at the 3 month, 1 year, 3 year, 5 year, 10 year horizon returns and how they have performed against their benchmarks, and invest in the top performers. And yeah, it is more in the more known funds that's there.
Fair.
But that's me because of my risk taking ability.
Fair. And, when it comes to these decisions, do you take your decisions for the entire family, or your husband takes it separately, or the fund selection is broadly on you because does your husband also come from finance sort of a background and, from an equity analyst?
He had a finance background, but he's all into IT now. But we take joint decisions, Ravi, because it's not, we don't look at it as our individual money. We still think it's the family money, right? So it's joint. We make sure that the whole portfolio aligns to what we believe in. And so for the risk-taking one, I do a lot of angel investments in startups. And that's where, all the risk comes in. That's next to gambling in a way, right? So if you're playing,
I disagree. It's not gambling. It is losing money. See, in gambling, you at least have a probability of making money, and you actually end up making money sometimes.
Both of us, me and my husband, like to say कि तुम करोड़ों रुपया भी कमा लो, खाओगे तो दाल रोटी. You're not going to eat sona chandi. So that's the thing, right? That's even within a company, right? When I've switched jobs, I'm okay with taking like a lower designation just because I'm getting to be part of a much more exciting team or a project. So that's something that we are comfortable with. And while I didn't read the book about Die with Zero, that's the philosophy that we've implemented. And growing up, that's always our parents said, ki agar if your child is worthy, you don't need to leave anything for them. And if they are unworthy, however much you leave, it's not enough.
तो वो है ना कि पूत कपूत तो क्यों धन संचय और पूत सपूत तो क्यों धन संचय. For me, allowing them the philosophy over there, and I am someone who went to a zero salary thing, so you'll always find me supporting, making less amount of money and actually doing the things that you would want to do. Yes, money is very, very important. It's absolutely necessary in this world. But perhaps understanding what is enough for you is a very important question that each and every one of you need to answer for yourself. So let's talk a little bit about your work at Microsoft for Startups, as well as the AI bit you are doing. And this is something that I am personally very interested in, because I'm actually doing an AI startup right now. For our listeners, do check out handauncle.com. I have been working on it for a little while with a couple of my batchmates from college. We are also hiring people right now. So if any someone from the AI ML engineering community is listening, our office is set up in Electronic City, Bangalore, in case any of you are interested. And I am in Jaipur, and I'm hiring for someone who can help me with content production as well. And that is where I want to come to you, Madhurima, as you currently head the Microsoft for Startups for India?
Not now. I used to do it till last year. Then I switched. So now I'm part of the AI transformation team in Microsoft.
So, Madhurima, you have a vast experience, working with startups, both at NetApp as well as leading the Microsoft for Startups program in India. So, first of all, as of today, if I'm an entrepreneur and I want to reach out to you for help, A, how do I reach out to you? And B, what are some of the aspects that you are helping entrepreneurs today with?
I think it's really a privilege for having worked with so many founders across stages, right? Right from the first time they started thinking about building a business to people who've actually become unicorns now. And some of the common things that I saw is that everybody struggles with a lot of self-doubt in the beginning, right? And on the other hand, there are few people who just have no self-awareness. So both kinds exist. They'll jump into an idea with a lot of passion, thinking that this is what the world needs and I'm going to save the world and all. And there are other people who are doing something that will actually change the world, but they are not sure if that's the right thing to do or if they're on the right path. So those are the kind of things I help startups with. Like, if you just want to use me as a sounding board, what are some of the things you should think about when you're starting a business? Before you invest significant amount of time, energy, and money, what are some of the things you should do? Especially for people who have, stable jobs, but looking at either the glamour of the startup world or either that they really feel that need from within that I need to do something on my own. How should you make that jump? Right? A lot of investors say that until and unless the founder is full-time, we will not fund him or her, which is fair from their point of view. But as a founder, is it foolhardy or does it really make sense? When is the right time to quit your job and jump into this way? So my advice, like common advice that I tell all founders is that until unless you have your finances sorted out for the next 2 years and you think you can live without earning a single rupee, that is don't leave a stable income paying job before that, right? However much you want to. So have that sorted. Because a lot of times you follow your passion and suddenly you start missing that regular paycheck. Ravi, I don't know if you ever faced that, but you start missing that, and the impact that has on your family dynamics kind of doesn't let you focus fully on your new venture, right? So make sure that you have enough nest egg and you have a spouse who will support you in the tough times on the money front. Don't jump into doing that is what I always tell founders. So for the people who've already done what they need in life and really want to, do something new, they've got their finances sorted, they should jump into this full time really, because unless you are full time in a venture, it won't grow. That's a given. So that is much needed. So those are the kind of things I help with people, right? You can, if they want personalized advice or 1:1, they can reach out to me through LinkedIn and book an appointment. Happy to do that. Especially today, nobody in India funds an idea, right? It's not true for Silicon Valley. There, just based on your idea, you can get funding. In India, there's still a long way to go for that. You need to show traction. And especially in today's environment, you need to show a lot of traction before somebody will invest money in you. So that's why you need to have that runway sorted. You have to bootstrap yourself and fund yourself for the initial days. For all the entrepreneurs, you would have heard this term valley of death, right? That you have to cross. That's become significantly broader and deeper. So get that finances sorted before you make that jump. It's a great idea, great product, but if you don't have funds to survive through the initial days, it's lost all the hard work.
Fair, I am fully aligned on that. It's just that I have been fairly lucky. So the last time when I started my company, my wife was in a state, she worked at Credit Suisse. It doesn't sound very safe right now, but 12 years ago, a Swiss bank was probably the safest job that there could be at that point of time. So that support was there, which helped me start at that point of time. And now I do have a little bit of money in the bank, which gives me leeway to take risks, and so to say. So I fully align with that, so people can potentially. And if you're looking for advice on startups, probably going to someone like Madhurima makes a lot of sense, because she has been doing it over a long period of time for a large number of startups, both as a professional career. And I think you also invest directly in companies as an angel investor as well. What are some of the parameters that you use to judge? And typically, first of all, have you had any exits in those investments? Because I have one which is doing very well. There are a couple of ones which did good on a fund perspective, but no 100 exit, at least for me. So have you had something like that?
No, none yet. Ravi, still waiting for that magical exit. But so far, honestly, it's been bad news only that's been coming, right? But as long as I feel that if a startup can survive the environment we are in right now for the next 2, 3 years, again, the tide will turn, right? And that's where they'll do. One observation I had, which was very counterintuitive to what I had expected it to be, that the non-tech investments are doing way better than the tech investments, right? So I think with AI and all, whatever happens, people will still need all the physical needs that they have. Ghar chahiye, roti chahiye, cold storage chahiye to move stuff from one place to the other. They will need somebody to build the houses for them. AI is something that has really changed the whole landscape for tech startups.
People who come to you for angel investments, so they reach out to you on LinkedIn.
See, for early stage, the most important is the founder and the founding team, right? What is her or his background? Do I feel that they are the best team to actually succeed in the area that they've decided to pursue? Because in early stage, there really is no background. There's no history. There's no profit numbers that you do a PE or whatever. There's no kind of valuation that really works. So it is wholly and solely whether that spark is there or not in the founding team. And how balanced is the team, right? I always look for having more than one founder, purely from a risk perspective, that if there's for some reason, one founder is unable to participate, the other person kind of covers up and takes the venture forward. So those are the most important things in early stage.
Moving into the other investments aspect of it. So the mutual fund part is there, and we discussed that. Angel investment is there. How are you doing with your real estate investments? So you talked about the first property that you purchased near the Google Hyderabad office a long time ago. Are you still actively investing in real estate, or it's just that the old investments which are going on? How frequently is there a churn in your real estate portfolio? How does that work?
So real estate, one thing I realized is that it's very difficult, right? When you go to buy something, everything looks like, oh wow, it's so expensive. And when I sell, I'll also get a good rate. But when you go to sell, it's not that easy. So, which is why conscious decision to stay away from making a lot of real estate investments, not doing that. And even looking at, in hindsight, right, the maths, it just pays way more to invest in the stock market rather than investing in real estate.
So basically, you own the house that you live in, your primary residence. Other than that, you don't really have a significant real estate exposure. So you're currently in Hyderabad or Bangalore?
Bangalore.
And so the house that you own is in Bangalore itself, and not maybe any other properties in, let's say, Ranchi or Hyderabad where you have other connections, or nothing of that sort.
No, it's too difficult, right? If you have land, then you're always worried about somebody grabbing it. If it is apartment, then I think apartments kind of depreciate over time. And then it is a lot of effort to find tenants to give you an income and all. So, yeah. And the rentals in India are not really that attractive, right? Unless there's capital appreciation on the asset itself, the investment is not justified, is what I think.
There is a large amount of data to support what you are saying. I am a little surprised that you are saying it in a slightly hushed, underconfident sort of a term. But no, that's absolutely right. It's extremely difficult to sell property in India. Large part of the market still operates on the black money principle. So let's say even if I want to sell it in a proper all-white kosher sort of a deal, I'm not able to do that because I'll not find a buyer, because the buyers are not really very willing, because they are the ones who will have to pay the registration costs which are involved. The registration costs vary state by state, but in Rajasthan it's around 8% and in some places it's 6, in some places it's 7. So if it's a 2 crore property and a 1 crore white and a 1 crore black versus all 2 crore and white makes a difference of 6-7 odd lakh rupees. Plus, it makes a difference on the capital gain taxes that you would potentially need to pay because that is there. So, other than the rental yield and capital appreciation being a concern, my key problem with real estate is that I can buy a mutual fund portfolio which will have 50 companies. Even if 5 of them don't do well, the other 45 will more or less compensate for that. I don't have enough money to buy 30 flats. So if I could buy 2 flats in Hyderabad, 5 in Bangalore, 3 in Chandigarh, and then I could have a portfolio of 40, 50 flats, it would make sense that, okay, some of them will do well, some of them will not do well, some of them will go on rent and generate yield, some of them will not do that. I agree with you on that. It's a very risky and a very different game to play. And obviously, there is angel investing to lose money in. It's nothing your goal there. On that note, I'd really like to thank you, Madhurima, for taking out the time and coming to our show and talking to our listeners. Before we leave, is there any one particular financial advice that you'd like to share with our listeners?
The only thing I'll say is don't spend everything. Live within your means. In fact, way below your means. Save, and invest it. Invest it in the right place, whatever works for you. But very important to do that. I cannot stress the importance of it. After having lived the first year not saving anything, I know it's important. So do that.
Well, so first year you didn't, but probably the 19 years after that you did that. And I hope you continue to invest for the next 19 yourself. Thank you, Madhurima. Thanks a lot for
Thank you.
coming.
Thanks, Ravi.
Thank you.